Over the past year, PepsiCo is down by 14.55%, and so with the upcoming earnings on the 4th of February, should you add this dividend king to your portfolio? Well, the thing you have to understand is that Pepsi is a very steadily but slowly growing company. You can see that over the past 10 years, they are up by only 46.61%, so they have underperformed the market. Now, this to many investors is actually a very attractive investment because of one reason: the growth is predictable. But with higher predictability, lower risk comes lower return, right? Well, unless you buy the company in a big dip and undervalued, which Pepsi currently is. So jumping straight to our stock valuation spreadsheets, I have already plugged in Pepsi sticker, so let's move straight to the dividends. We can see that Pepsi currently has a very high dividend yield of 3.80%, and I will get back to this a little later in the video. We can also see that they have a very high trailing free cash flow payout ratio of almost 95%. Now, as most of you know, I don't like the free cash flow payout ratio to be above 50%, as that would mean that the company cannot direct most of their free cash flow into innovation. But as Pepsi cannot really innovate, the only place where they can push their free cash flow into is dividend payouts, so I'm quite fine with their trailing free cash flow payout ratio being this high. Now let's get back to the dividend yield. If we jump back to Seeking Alpha and move to the dividend yield tab and scroll a little down, we can see that currently PepsiCo has the highest dividend yield they have had over the past 10 years. Normally their dividend would be sitting anywhere around 2.5%, and currently it is sitting at 3.80%, which is more than 33% higher than the normal range. But now let's understand why this is so great. If I scroll down to the yield on cost tab, if you were to invest into Pepsi 10 years ago, your yield on cost would be 5.78%. Now, if you remember, 10 years ago, the dividend yield of Pepsi was sitting at about 2.5%. So if you were to invest into Pepsi right now with the dividend yield sitting at 3.8% in 10 years, your yield on cost could be well above 10%. And that means if you were to invest $10,000 in 10 years, Pepsi could be yielding you $1,000 every single year. And that's why the dividend yield being this high out of the ordinary is for many investors, including me, very attractive. But now let's move to the 9 pillars, and you can see that Pepsi gets a rating of 6 out of 9. Now, the one thing that concerns me regarding Pepsi is their high long-term liabilities over the 5-year free cash flow negative dividends ratio sitting at 17.90, while we want it to be sitting anywhere below 3. And this essentially means that while paying out their dividend, it would take Pepsi about 90 years to pay off all their long-term liabilities with the free cash flow they currently generate. If we jump closer to Pillar 9, we can see that they currently have about $50.5 billion in long-term liabilities, and they've actually been raising them at a rate of 5.15% every single year over the past 5 years. Now, the reason why this doesn't bother me enough not to buy the company is that if Pepsi was to get into legal trouble and had to pay down all their long-term liabilities, if they cut their dividend, they could do it in about 10 years with the free cash flow they currently generate. So I'm quite fine with the ratio being this high. But now let's also have a look at the growth of the company. As I said at the beginning of the video, Pepsi really isn't expected to grow that much as they've already conquered most of the market. We can have a look at their revenue growth, which has been growing at a rate of 6.56% yearly over the past 5 years. Their free cash flow has been increasing at a rate of 12.23% yearly, and their net income has been increasing at a rate of 5.79% yearly. Now, what I like the most about this is that their highest increase is in the free cash flow. And this is because the free cash flow is essentially the blood of the company. It is used for everything, from paying out dividends to mergers. So with the free cash flow growing at the highest rate, PepsiCo is also most effectively growing their value. Now, as always, if you'd like to download these spreadsheets for your own personal use, you can do so at the link in the description. Now, what I also like about the company is that they have decreasing shares outstanding, and the reason why I like this so much is that when a company decreases their shares outstanding, they essentially increase their earnings per share, growing the company's intrinsic value more effectively. PepsiCo's 5-year profit margin is also sitting at 10.17%, which is close to being in the red, but if we have a closer look, we can see that it has been moving around 10% for most of the past 5 years, and currently it is sitting at 10.18%. But on average, it has been increasing at a rate of 1.19% yearly, so we do have to keep an eye out for the profit margin. Now let's also have a look at the 5-year P ratio and the 5-year price to free cash flow. We can see that over the past 5 years, the P ratio on average was sitting at 26.99. Now if we zoom into pillar 1, we can see that currently it is sitting at 21.01. So compared to the price to earnings at which they were trading in the past, Pepsi would currently be considered undervalued. And this is actually the same case with the price to free cash flow. We can see that currently it is sitting at 24.89, and over the past 5 years on average it was sitting at 32.22. So PepsiCo would also be considered undervalued compared to their historical price to free cash flow. Now let's have a look at the final metric, the consecutive dividend growth, which is sitting at 6.69. And this is also one of the reasons why many dividend investors love this company. They have predictable high dividend growth. And so now that we have gone over the 9-pillar analysis, let's calculate Pepsi's intrinsic value. So first, jumping to the Graham's formula revised, we have to plug in the 5-year earnings growth estimate. And to do this, we will predict the high earnings per share growth estimate, the medium, and the low. I will then combine this with the analyst projections and get an average 5-year earnings growth estimate at 5.45% yearly over the next 5 years. And combining this with the other 5 metrics, plugging it into the Graham's formula, we will get an intrinsic value of $106.51, which is 34% lower than the current trading price. So even though PepsiCo would be considered undervalued compared to their historical P ratio, they wouldn't be considered undervalued compared to the average P ratio. But we still have 3 more valuation models to go through. So jumping to the second valuation model, the discounted cash flow model, we will plug in the free cash flow of the company over the past 5 years and calculate an average growth rate of 12.23%. Now into the future, I will calculate a growth rate of 6.3% and calculate the future free cash flow into the next 8 years plus. I will then plug in a discount rate at 6.2%, and the discount rate is essentially the minimum rate of return I would like from an investment into Pepsi yearly. I will then use this discount rate to calculate the present value of all of that future free cash flow. I will sum it up, add cash and cash equivalents, and subtract total debt to get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $192.22, which is higher than the current trading price. Now let's also compare Pepsi to its competitors. So we will compare Pepsi to Coca-Cola, Celsius, and Monster Beverage. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We will then average them out and multiply by the earnings per share of Pepsi and get an intrinsic value of $213.64. But let's jump to the final valuation model, the dividend discount model, where we will take the dividend payouts over the past 5 years and calculate the average growth rate sitting at 6.87%. Now, as I want to be conservative, I will project a growth rate of 4% into the future and get an intrinsic value of $234.18, which is quite higher than the current trading price. And finally, moving to the ultimate valuation, we will average out the 4 valuation models and get an ultimate intrinsic value of $186.64, which is 30.1% higher than the current trading price. And with a margin of safety of 15%, we would get an acceptable buy price at $158.64. Now, I do believe that right now, before Pepsi's earnings, it is the best time to add the company to your portfolio and hold it for the next 10 years plus, as it is a great company. And with that, let me know down in the comments if you are buying, selling, or holding Pepsi, and also make sure to like and subscribe, as it really helps me out.